Imagine a stock that suddenly rockets up hundreds or even thousands of percent in just a few days. Headlines explode, social media lights up, and everyone wants to know what just happened. That, in essence, is the power of a short squeeze. It's one of the most dramatic and emotionally charged events in the stock market. And when it happens, fortunes are made and lost in the blink of an eye. Today, we're going to break down what a short squeeze really is, how it happens, how investors can identify potential setups before they unfold, and most importantly, how to manage risk when trading or investing around one. We'll explore famous examples like GameStop, BYND Meat, Tesla, and others that have shown just how explosive and dangerous this phenomenon can be. Let's start from the ground up. When investors short a stock, they're essentially betting that its price will fall. To do this, they borrow shares from a broker, sell them on the open market, and hope to buy them back later at a lower price. The difference between the sell price and the buyback price becomes their profit. But there's one massive catch. Unlike going long, where your maximum loss is limited to the amount you invest, a short position has theoretically unlimited risk. A stock can only go down to zero, but it can rise infinitely. If the price starts climbing instead of dropping, short sellers can be forced to buy back the stock at higher and higher prices to cover their positions. This cascade of forced buying pressure can send the stock price into a vertical surge, and that's what we call a short squeeze. One of the most famous examples of this in modern history is the GameStop short squeeze of early 2021. GameStop was a struggling video game retailer that many hedge funds viewed as a company in decline. The short interest, that is, the percentage of shares sold short, had reached astronomical levels, over 100% of the company's float. That means there were actually more shares shorted than available to trade. When retail investors on Reddit's Wall Street Bets noticed this imbalance, they began buying the stock aggressively, coordinating on forums, and driving demand higher. As the price surged, short sellers began to panic. They were forced to buy back shares to limit their losses, and that additional demand caused the stock to rise even further. What followed was one of the most spectacular short squeezes in history. GameStop soared from under $20 to nearly $500 in a matter of days. But GameStop wasn't the first and won't be the last. Tesla experienced several smaller short squeezes in its early growth years when many on Wall Street doubted the company's viability. In 2013 and again around 2019, Tesla shares skyrocketed as bears were forced to cover their short positions, sending the price even higher. BYND Meat, the plant-based meat company, also saw a massive squeeze after its IPO in 2019. The stock went public at 20 and within 2 months, it was trading above 230. With a limited float and massive demand, short sellers got burned badly as momentum investors piled in. So what actually creates the conditions for a short squeeze? It's usually a combination of several ingredients. The first is high short interest. That's the percentage of available shares being borrowed and sold short. The higher this number, the greater the potential energy stored in the trade. When too many people are betting against the same stock, any positive news can turn into a spark that ignites panic buying. The second key ingredient is limited float, meaning there aren't that many shares available for trading. When supply is tight and demand spikes, prices can move violently. The third factor is a catalyst. It could be strong earnings, a strategic announcement, a big investor buying in, or even viral attention on social media. Once that spark hits, shorts scramble to cover and the snowball starts rolling. Now, identifying a potential short squeeze before it happens takes research and discipline. Traders often look for stocks with short interest above 20 or 30% of the float. They'll also analyze the short interest ratio, sometimes called the days to cover metric, which measures how many days it would take all short sellers to cover their positions based on the average trading volume. The higher the ratio, the more difficult it is for shorts to exit quickly, which increases the potential for a squeeze. Momentum indicators, rising volume, and unusual call option activity can also hint that bullish speculation is heating up. A good example beyond GameStop and BYND Meat is AMC Entertainment. Like GameStop, AMC was heavily shorted as many believed the pandemic would devastate movie theatres. But retail traders saw the setup and piled in. The result was another massive squeeze in mid-2021, with AMC's stock price jumping over 2,000% within months. The frenzy wasn't entirely about fundamentals. It was about mechanics, psychology, and the sheer imbalance between supply and demand. However, not every stock with high short interest turns into a squeeze. Sometimes heavily shorted stocks just keep falling. That's why risk management is crucial. Short squeezes are unpredictable and volatile. Prices can swing wildly within hours, and those who chase too late often end up holding the bag when momentum fades. For investors trying to capitalize on a potential squeeze, it's critical to set clear entry and exit rules. Use stop losses, take profits in stages, and never risk more than you can afford to lose. Remember, once the short covering is done and the buying pressure dries up, prices can collapse just as quickly as they rose. There's also a difference between a short squeeze and a long-term turnaround. In the case of Tesla, for example, what started as a short squeeze was reinforced by fundamental improvements: stronger earnings, growing demand, and strategic leadership. That's why the stock continued to climb long after shorts were gone. In contrast, GameStop and AMC saw their prices fall dramatically after the initial hype faded because the fundamentals didn't justify the valuations. So the key is distinguishing between a technical squeeze and a genuine business recovery. Another interesting example is Volkswagen in 2008, which briefly became the most valuable company in the world due to a short squeeze. Porsche had quietly accumulated a large position in Volkswagen shares, and when they revealed it, short sellers realized that only a tiny fraction of shares were left available to buy. The panic was instantaneous. The stock quadrupled in a matter of days as funds scrambled to cover. That squeeze wiped out billions in hedge fund losses and remains one of the most extreme in history. To put this into perspective, think of a short squeeze like a crowded theatre, where everyone wants to exit through the same small door at once. When panic sets in, prices shoot up because there aren't enough sellers willing to meet the desperate buyers. But when the crowd clears, the excitement fades, and the stock often returns to more reasonable levels. Timing that perfectly is almost impossible. For those interested in spotting these setups, several tools can help. Platforms like FINRA and NASDAQ publish short interest data twice a month, and services like Ortex or Market Beat track short percentage of float in real time. Options activity can also reveal clues. Heavy call buying and rising implied volatility can signal speculative bets ahead of potential catalysts. Social media sentiment tracking tools can be useful too, especially since platforms like Reddit, X, and Discord have played major roles in recent squeezes. It's also worth mentioning the psychological side of short squeezes. There's a sense of rebellion when retail traders gang up against large hedge funds. The GameStop saga was as much a cultural event as it was a financial one, a David versus Goliath story that energized a new generation of retail investors. But emotional trading can be dangerous. When the crowd mentality takes over, people often ignore valuation, fundamentals, and risk, focusing only on potential gains. Many latecomers to the GameStop and AMC squeezes ended up losing most of their investments as prices came back down. From a broader market perspective, short squeezes also serve a purpose. They remind traders that excessive shorting can backfire and that markets are ultimately governed by supply and demand. They can also act as a natural check against herd behavior on Wall Street. But while they make for great stories, they're not a sustainable investment strategy. The goal for long-term investors should always be to find fundamentally strong businesses, not just temporary dislocations. If you're considering trading around a potential short squeeze, think about risk in layers. The first layer is position size. Never allocate a large portion of your portfolio to a speculative trade. The second layer is timing. Look for confirmation in volume and price action, rather than trying to predict the exact moment a squeeze begins. The third layer is discipline. Take profits early and often, and don't let greed cloud your judgment. In these setups, the faster you are to react, the safer you'll be. In contrast, short sellers also use risk management to protect themselves. They may hedge positions with call options, set strict stop losses, or diversify across multiple shorts. The best professional short sellers focus on deep research and avoid overexposure to single names that could squeeze violently. That's a lesson that many funds learned the hard way during the GameStop and Volkswagen episodes. Another evolving trend is the rise of algorithmic trading and data-driven platforms that monitor short interest and liquidity conditions in real time. These systems can detect unusual volume spikes or imbalances long before retail traders notice, meaning modern squeezes may form and unwind much faster than in the past. The volatility can be extreme, but so can the opportunity for those who understand the mechanics and stay disciplined. In the end, the short squeeze is one of the most fascinating dynamics in the stock market. It's a raw display of fear and greed colliding head-on. It shows how collective behavior, leverage, and psychology can overpower logic and fundamentals, at least for a short time. Whether you view it as a trading opportunity or a cautionary tale, it's a reminder that markets are never purely rational. So the next time you see a stock suddenly shooting higher for no apparent reason, check the short interest, the float, and the news flow. You might just be witnessing the start of another squeeze. But remember, while some made life-changing profits during events like GameStop or Beyond Meat, many others got caught in the aftermath. Respect the risk, study the data, and never chase the hype. Because in the world of short squeezes, what goes up fast often comes down even faster. That's the real story behind short squeezes: the mechanics, the psychology, the opportunity, and the danger. Whether you're a trader looking for volatility or an investor trying to understand market dynamics, learning how and why short squeezes happen can make you a smarter participant in the markets. The key is balance. Stay curious, stay informed, and above all, stay disciplined.